and welcome back for the next episode of our Ultimate Lease Accounting series. Previously, we covered several lease basics, including locating key dates in a lease agreement and how to use that information to determine the lease term. During this next video, we'll go on to define the lease liability, and I'll highlight the various types of lease payments included under ASC 842. Let's begin. The lease liability is equal to the present value of future lease payments. Seems simple enough at first glance, right? The lease liability will always equal the present value of any remaining lease payments. This is the same at commencement of the lease as it is at transition. However, to do this, you must determine two things: the payments and the discount rate. Let's look at the payments first. The consideration that can be paid in exchange for the use of an asset can take many different forms and vary in amount, timing, or triggering events. ASC 842 lists the types of lease payments to include in the lease liability calculation. They are fixed payments, including in substance fixed payments, variable payments tied to an index or rate, purchase options and termination penalties the lessee is reasonably certain to incur, fees paid to a special purpose entity for structuring the transaction, and residual value guarantee payments. So let's spend some time discussing some of the considerations for each of these various types of lease payments. First, fixed and variable consideration. Fixed consideration is a payment made directly for the right to use the underlying asset and that is explicitly stated in the lease contract. The amount stays constant to what is specified in the lease agreement. These payments will be included in the measurement of the lease liability and right of use asset. Variable consideration, on the other hand, is a payment incurred for the right to use an asset that cannot be calculated without the occurrence of an event, such as an amount of sales, units produced, or reconciliation to an actual amount. These payments are typically not included in the measurement of the lease liability or right of use asset and are simply expensed when incurred. We will talk about that one exception to this treatment in a later slide. Some examples of variable payments are rent as a percentage of sales or a per mile rate for miles over a certain threshold. A type of fixed payment typically seen in a lease agreement is base rent. Base rent is essentially the minimum required payment for a lease, and usually it is explicitly stated in the contract and will be included in the calculation of the asset and liability. If the contract includes escalations, such as base rent increased by a stated percentage annually, as long as the increased percentage or amount is known, this type of rent is fixed. On the other hand, variable payments can sometimes look like fixed payments. For example, a specified amount of property taxes or insurance is added to the base rent amount. If the tax and insurance additions will be reconciled to actual costs at a future date, and the lessee is required to pay that difference, the cost is considered variable because the final amount is dependent upon actual expenses. In substance fixed payments are the opposite of variable payments presented as fixed payments. These payments may seem like variable payments at first glance. For instance, payments based on a future amount of sales and a required minimum amount. While the amount based on sales is variable and cannot be calculated until sales are known, the minimum required payment is an in-substance fixed payment. The lessee knows the minimum amount owed, regardless of whether the additional sales are made. The minimum amount can be included in the lease liability calculation. As another example, let's look at a payment calculated as miles or usage over a certain threshold times a rate. The lessee can calculate the lease liability with the base amount, and any mileage or usage overages are variable lease payments to be expensed when or if incurred. Now let's go back to discuss variable payments that depend on an index or rate. These are included in the initial lease liability calculation. The Consumer Price Index, or CPI, is a good example of an index which lease payments may be based upon. You've probably seen a lease agreement with base rent payments increasing by CPI annually. Like the mileage payment example from earlier, the CPI in effect when the lease begins is known, and can therefore be used to calculate the initial lease liability with the index or rate at the lease commencement date. Then, over the term of the lease, as payments are made with the actual index or rate applied, any variance is recognized as expense. What you want to watch for, however, are increases based on changes to CPI, such as a percentage increase from the preceding 12 months, or any similar calculations. That increase or change to the rate or index is an event that has not yet happened, so this type of variable payment would not be included in the lease liability. And here are some additional payment types to consider including. A purchase option, if the lessee is reasonably certain to exercise that option. Penalties for terminating the lease, if the lessee is reasonably certain they will terminate the lease and incur these fees. Fees paid by the lessee to the owners of a special purpose entity for structuring a transaction, and payments for residual guarantee if the payments are probable of being owed by the lessee. Now, this is not a complete list, but these are definitely the major types of payments to look for within a lease agreement to calculate your lease liability. You'll note here, several of these types of payments are related to a choice or decision. This is another time in applying ASC 842 that reasonably certain comes into consideration. We covered this in a previous video when discussing determining the lease term. Reasonably certain is a relatively high threshold. With payments based on an election or decision, the lessee must determine whether they are reasonably certain they will terminate at a specific time, elect to take or not take a purchase option, and so on. When looking at these decisions, let's also remember the further you move into the future, the harder it becomes to be reasonably certain. Also, make sure your analysis includes reviewing any economic incentives and what the organization has historically done. Now let's switch gears to lease components. Sometimes the discussion of lease components gets mixed up with the discussion of fixed and variable payments, but they are actually categorizing two separate things. The components of a contract are just the different pieces and parts of the contract that grant different accesses or services or require different types of consideration. Lease components are sections of the contract which directly transfer the right to use the underlying asset to the lessee. A lease component can require fixed or variable consideration, but whether a payment is fixed or variable does not determine whether it is a lease component. A non-lease component is a section of the contract which transfers a good or service to the lessee separate from the use of the leased asset. And there are also non-components. Non-components are payments that do not directly contribute to the right to use the underlying asset and do not transfer any value to the lessee. Typical examples of non-components are property taxes or insurance. These are reimbursements to the lessor and don't factor into the right to use the lease asset or impart any value to the lessee. An example of a non-lease component is CAM, or common area maintenance. CAM is generally a payment for maintenance, landscaping, janitorial, or other services related to the lease. The lessee is paying the lessor for a service, but the CAM does not directly transfer the right to use the underlying asset to the lessee. Some types of payments, like security deposits, may be either a lease or non-lease component. To determine whether or not a security deposit should be included in your lease payments, look at if it is refundable or non-refundable. Refundable deposits are not included as lease payments. You are not paying for the right to the asset or a service. But non-refundable payments would be because they are part of the consideration paid for the right to use the asset. Generally, you can have lease agreements with one payment stream consisting of both lease and non-lease components, like base rent plus CAM. When this occurs, ASC 842 requires the lessee to take the total contract consideration, all of the components and their payment combined, and allocate the consideration to each of the individual lease and non-lease components based on a relative standalone price basis. The lessee is to use the observable standalone prices for each component for the allocation. Or if the standalone prices are not available, estimate using the available market information. As you can imagine, this can be a whole lot of work. However, you are in luck, as the guidance offers a practical expedient whereby lessees and lessors can elect by class of underlying asset to treat each lease and non-lease component as a single lease component, saving the resources required to separate these costs. You will definitely see this election made quite a bit in practice for the resources it can save. But remember, anytime you are increasing lease payment amounts to include in the lease liability, you are also increasing the lease liability and the right of use asset. Okay, so we've talked about the lease payments. Now let's talk about the discount rates. This is the other piece of the net present value calculation for the lease liability. ASC 842 states that the rate implicit in the lease is the preferred rate to use. This is the rate that best represents the intended economics of the lease. This is the rate that the lessor is charging. However, the guidance also concedes that this rate is often not easily determined by the lessee and therefore offers some alternatives. The first alternative is the incremental borrowing rate, or the IBR. N&D's IBR is the rate they would be charged to borrow an amount similar to the lease amount over a similar term on a collateralized basis. The definition is updated from the discount rate allowed under ASC 840. Then private organizations have an additional option to elect to use a risk-free rate at an underlying asset class level. The risk-free rate is defined as the theoretical rate of return for an investment with no risk. Typically, private entities would use the T-bill rates published on the treasury.gov website. When choosing a rate, consider that although the risk-free rate can be estimated more easily than the IBR or implicit rate, lower discount rates lead to higher opening lease liabilities. That wraps up this episode. Join us for our next videos.